It is almost 11 a.m. here in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin, live from Super Return Asia in the Lion City. The top stories. Bloomberg learns that China is considering injecting up to $142 billion into its biggest state banks to help support the economy. Asian equities rallying on the back of technology stocks. The gains fueled partly by Micron's stronger than expected sales forecast on AI demand. And we speak exclusively in a few minutes with David Hunt, the CEO of PGIM, which manages assets worth more than $1.3 trillion. We discuss market risks and opportunities as the U.S. and China focus on boosting their economies. Let's do a quick check on how markets are shaping up. Asian stocks trading at a two-year high, led by a fresh rally in Hong Kong and mainland China. The yuan also extending those gains. Remember that it reached the 7 mark yesterday. That's on a Bloomberg scoop that Beijing is considering injecting up to $142 billion of capital in its biggest state banks to boost their capacity to support the economy. Let's get insights, perspective. Let's bring in our China correspondent, Min Lo. Min, how should we interpret this move on the back of that stimulus measures we saw earlier this week?
Yeah, I mean, we already get a hint of this on Tuesday when the PBOC governor had said that they were going to inject some capital into the big banks. So I guess today we're getting a little bit more details that it could be as much as $1 trillion RMB, coming majority of it from special government bonds. And this is another injection of capital to the banks at a time when the profit margins have been squeezed. It's at record low as of end June of only 1.5%. That's below the threshold that is deemed necessary for reasonable profits, which is 1.8%. It also comes as the banks have time and again been asked to do national service, right, to revive the economy with the mortgage rate cuts. That alone is estimated to save homeowners about 150 billion yuan in annual interest payments. That's money that is no longer going to the banks. And then you have cuts to loan prime rates that the PBOC said could be coming. The PBOC governor promised that all of these rate cuts is going to be neutral on banks' profit margins. So perhaps this release of funding is meant to support that. But it's also quite nuanced because our Bloomberg Intelligence analyst Francis was saying that many of these banks, they actually do not need that capital injection, given that the capital adequacy ratio is very sufficient. It's a few percentage points above that 8.5% required of systematically important banks. So they do not need it. He thinks that this is a signal that maybe the PBOC is going to ask banks to take on more loans to risky sectors like the property developers, or maybe bailing out local governments, because if the banks are going to be asked to take on more risky or bad debt, then they will have to ensure that their balance sheet are stronger to just protect themselves in the case of a growth in the amount of non-performing loans they may have to take up.
Min, if that is not enough, we're also hearing from state media that China will give out direct cash handouts to its people. Pretty unusual, but how effective might that be?
Yeah, it is quite a departure from the past, given that presidency is known to be very resistant to this sort of welfarism. Chinese officials have previously said that it could lead to laziness, but economists have been calling for this sort of direct handout for a while now, given the weakness in domestic consumption. So it looks like the government is heeding this call. We don't know yet how big of a cash handout it would be, but we know it will benefit some 4.7 million people who are extremely poor. They're supposed to receive this handout before the start of the Golden Week holiday, which is traditionally a time of peak travel and holiday season. But of course, maybe the extremely poor may not be going on a holiday, but maybe it could give a boost to those household appliances or essential goods, consumer staples. That's a sector that has been one of the worst performing in the Chinese economy so far. And it's, by the way, the 75th anniversary of the founding of the PRC. State media is saying this is a sign of the government and the party showing their care and love to the people as well.
Of course, investors have been concerned about consumption. This is one way perhaps to boost consumption in China. Bloomberg's China correspondent Min Lo, thank you so much for that update. And we're coming to you live from the Super Return Summit here in Singapore to discuss private markets, buyouts, venture capital and more. But top of mind for participants here is, of course, Fed's easing, China's stimulus plans, and, of course, geopolitical tensions. Let's bring in David Hunt, President and CEO of PGIM, which has more than $1 trillion in assets under management. Good to have you with us.
Oh, thank you for having me. It's great to be here.
We talk about that confluence of developments in the world today, prompting a sense of volatility in the investment climate. How are you assessing how it's feeling right now?
It does, but I will say that I would think the mood among large institutional investors around the world is different. And I think that they are more focused on the geopolitical risks than they are on the business cycle. Any time I can remember for the last few years, I think they really do feel that as they look back at their portfolios, that between the global pandemic, the two wars, they have been more buffeted by idiosyncratic political and health risks than they have by the kind of classic business cycle. And so most of them are actually really rethinking their portfolios, trying to make sure they're resilient in the face of what are probably some pretty unknown risks in both the security and the economic areas. And this week showed some very good examples of that.
So how does a resilient portfolio look like? What changes are being made to that portfolio? So
obviously it depends on the individual portfolio's risk and return objectives. But I can give you two broad themes. One of them is I think that there's a whole newfound respect for liquidity and the need for liquidity. I mean, if we look at our investing, some of the best returns that we've had were vintages of 09, 010, were 21, 22. And our clients who had capital at that point and were able to take advantage of some of these moves really did well. Other clients who maybe had gotten too much into private markets or they had too much illiquidity weren't able to do that. And so most of our clients are building in more liquidity than they have in the past. And the second one is diversification. I think that people really have a whole new appreciation for how diversified supply chains need to be in a world where much of the manufacturing of the world came from China. That's really has changed in the last decade, and people are needing to reflect that in their portfolios. So those are the two big changes that we're seeing in strategic asset allocation, and I think that we're only at the beginning of kind of the evolution of some of those.
Speaking of China, David, we heard additional measures
really
from China ramping up its efforts to prop up the economy, now propping up consumption as well. What's your take on China's moves so far? It shows a sense of urgency, but is it enough for investors to, I guess, perhaps reverse their opinions on investing in China?
Yeah, I think that sentiment around China is certainly better now than it was 6 months ago, for sure. I think just the last 2 weeks of changes do show a sense of urgency and a sense of resolve to get after some of the underlying structural issues. But I think most people, including ourselves, believe that more needs to be done to rebalance toward consumer and consumption. And it'll be very interesting to learn more details of actually how they're planning to do that, and whether or not that can make a big enough difference. Because simply supporting manufacturing and beginning to get the banks in better footing, they're very necessary, but won't really achieve the evolution in the economy that they need.
What would you like to see?
I would much prefer to see some real focus on the consumer and making sure that there is more money in the pockets, more savings, and more ability to consume and not just and invest for individuals. And that, I think, is what would give people a lot more confidence going forward. But I think, this is a down payment. And as I said, I think sentiment is better.
That 5% growth target, do you think, is achievable for China this year?
Very hard to say. It's very much going to be dependent on how I think some of the structural reforms in the banking sector are implemented. So, overall, our belief is that China will look more and more like other, developed economies, and their growth rate will naturally come down, and that's actually okay. The question is less the level of growth and more how it's distributed between manufacturing and personal consumption, and that's where we'd like to see the shift.
David, let's talk about Japan. It's been, of late, the favorite market for a lot of investors. It is a higher rate environment. Of course, the bar was really, really low. Are you looking at Japan differently? And what's looking interesting in Japan?
Yeah, so I spent 2 weeks there in April, and I did come away feeling that maybe there is more hype, but that there actually is real substance to the change. I mean, you do see prices coming up. You do see wages going up. You do see corporate reform that they've talked about for a long time, but actually getting implemented. And, the idea of higher ROEs for the corporate sector is now starting to really take shape. So, yes, I think that maybe we've got a little bit ahead of ourselves in the markets, but do I have more confidence that Japan is on the right path from a very difficult 20 years? Yes, I do.
Well, what would you buy in Japan? What's interesting? What are the sectors that investors should be looking at?
So Japan, like many other developed economies, has major opportunities around their aging population. And so when we look at senior living and we look at sectors around healthcare, those are going to be major growth areas for them. And then we do think that Japan has been sort of oddly enough one of the leading beneficiaries of the tension between the U.S. and China. And so you're starting to see chip manufacturing move there. You're starting to see people basing their export strategies for Asia out of Japan. And that's a new phenomenon. So there's plenty of opportunity, I think, in Japan.
When you talk about opportunities in this part of the world, in Asia, by that I mean, do other markets stand out? If you take a look at shifts in supply chain, a lot of the countries in this part of the world have benefited from it. Is there a different way of looking at the region right now?
So I have long tried to absolutely kill the idea of emerging markets, that this was a useful definition. And the idea that South Korea and Singapore should be lumped together with Vietnam and Argentina, I just find extremely difficult to handle. So we work a lot with clients to kind of just pull apart emerging markets, and some of them we treat like truly developed markets like Korea and Singapore. Others we treat very much more like are going to benefit from the changes in supply chains, and that would include Indonesia, Vietnam, but also, by the way, Mexico. And so I think there's a really sweet spot of emerging economies there, which are doing very well. And then there's, unfortunately, a bunch of basket cases, which we probably won't be touching anytime soon.
But an outperformer in Asia has been India, but valuations are looking very overstretched. Even then, even the PE, the private market is pretty excited, remains excited, saying that lots of opportunities. Should there be some trepidation when you take a look at the Indian market?
So I do think that the excitement in India is real, and I think that the reforms that they have made are important, and the underlying growth rate has actually been very nice to see. What I look for in India is actually a deepening of the capital markets. Many of these markets remain very shallow. The corporate bond market is, the private markets are, the real estate market is still largely handled by, kind of a very few companies. It's not very liquid. So I would love to see a more institutional asset management business and pension business grow there. And I think that would deepen the capital markets. And in that respect, you will see less of the volatility, both on the upside and the downside, and more real progress in valuations.
Let's talk about the private market. You believe that reinsurance, for instance, will be the next big thing, in Asia included.
I do. I mean, I think I joked earlier today that I don't think we will have conferences that are around private markets in the future, because I don't think as a concept it will last. I think that private markets, private credit in particular, as it becomes more developed and more mature, people will look across public and private markets, which is why we believe in offering both of those. And our clients want a blend of public and private portfolios as they put together. So the idea that somehow there's this private thing, which is a completely different allocation, I think will go away. Now, one of the reasons that has happened more rapidly in the U.S. and in Europe has been that private credit in particular is being, and ABF, has been used to back insurance liabilities, whether or not it's reinsured or not. And I do think that the reinsurance piece of this continues to get more and more important. More capital is being brought in from outside the insurance industry. And I think that is driving real opportunity for private markets providers such as ourselves who have access to those kinds of insurance liabilities.
So where are the big markets for reinsurance in Asia? Would it be the likes of Indonesia? This is a country of 260 million people experiencing good growth, and perhaps, insurance is underpenetrated.
So it is, but the place to really look for the kinds of liabilities that I'm referring to are going to be in countries that have more of a demographic that's older. So the number one country I would give you is Japan, where not only do you have a whole new capital regime that's coming into the insurance market there, you have a lot of insurance companies that are struggling already to meet capital requirements, and they're going to need to find innovative solutions to bring more capital into that. So that would be my leading market for you at the moment.
And private credit, what are the opportunities here? Because this is a massive sector. We're talking about $2 trillion. How would you position for that?
No, it's been very rapidly growing. Private credit has probably been our fastest growing business for sure. We have about $100 billion under management. And I think that where you're seeing the biggest growth is the places where banks have been kind of pulling back. I would say Australia has probably been the best example of that. But you do see that a little bit here. You do see that in places like Indonesia. And so I think there are clearly nice growth opportunities for private credit across the region.
But how sustainable is the boom in private credit right now? The likes of New York Life CIO saying that, that boom might turn to bust. There are lots of concerns over there.
So like all markets as they develop, they do that in a nonlinear way. And we had 5 years of enormous growth, I think, in private credit. That's now maturing, and I think that's actually a good thing. So allocators have gotten much better at distinguishing people who are good at this. They're underwriting, they have workout capabilities, they have a distinctive origination force. And if you're just kind of two guys and set up a little bit of a trading floor, you're going to have trouble raising money. So I do think you're going to see a maturation of this. You're going to see many of the smaller players have trouble raising money. And if we go through a good old-fashioned recession, you will see some of them struggle. But that's no bad thing. That's how almost every market that has evolved and developed, we go through periods that they're very rapidly growing, a little bit of a reset, and then they grow again. But the underlying structural change to the privatization of credit across economies is here to stay.
But the thing is, there are concerns because it is pretty opaque. Some say it warrants greater oversight. Do you agree?
So I think that it's really an interesting debate as to whether or not credit risk is better off on a bank balance sheet or whether or not it's better off in a private credit fund. So I could argue that the riskiest place for it is actually in a bank's balance sheet because they have a huge asset liability mismatch with their deposits. And when we go through a credit cycle, then they have to write off that credit, and that actually means that deposits and lending contract. Now, if we go through a credit cycle, the LPs and the GPs are going to take it on the chin. No one will probably feel very sorry for them, but it won't ripple through the banking system. So at least up to a certain point, I would actually say from a prudential point of view that the private credit is actually a more stable form of lending than having it come through the banks.
David, I'd be remiss not to ask you about the Fed. You manage, after all, $1.3 trillion, 50 basis point cut. Where does it go from here? In the first place, was it the right move?
So it was a bold move for sure, and I think that they wanted to make the point that they wanted to be ahead of the curve. And that, I think a lot of them are smarting a little bit from inflation is transitory and feeling that they were a little bit late, and they didn't want that to happen here. And so that was a strong message that came. I think, as ever, the market has probably overinterpreted that. So if you look at the forward rates now and the implied cuts, I think they're probably too aggressive than what we would believe is going to happen. But rates are going to begin to come down, assuming that the economy continues to do well. Remember, in the U.S., rates are coming down because the economy is strong. Very different from Europe, where rates are coming down because the economy is weak. And that's a very different situation.
When we talk about the Fed right now, it is about neutral rate. That is the focus. And we're looking at perhaps the Fed getting to neutral, I think in the beginning of 2026. Might it get to neutral way faster than that with incoming data and perhaps the need to support the U.S. economy?
It certainly could do, and I think the Fed takes particularly the labor market, very seriously. And if they believe that they could move R-star down more faster in order to still preserve the labor market, I think they would do that. But that will be data dependent. And if they start to see unemployment come up faster than that, then I think you'll start to see that begin to slow. I think they are very serious about allowing this data as it comes in to inform their choices rather than being on a kind of set glide path.
And you're comfortable with the idea that the Fed can navigate a soft landing?
I do. I think that certainly at the moment is our base case, that we will have a soft landing in the U.S. But we also have, our kind of second favorite scenario, which we call weakflation, which is where, inflation stays high and we do see growth begin to slow. And I think that is possible, too. And I would also say that I can imagine a world where inflation goes back up, right? I mean, if you had either the price of oil through some kind of geopolitical risk go up, or you had a world where tariffs became much more prevalent, you could imagine inflation headed the other way, and then the Fed could have to reverse. But I think that they are very committed to being flexible and data dependent.
It is not just about the Fed. It's also about the other central banks. And we're beginning to see a divergence. We talk about how China is actually cutting rates while Japan is trying to raise rates. Where are the opportunities when you take a look at this divergence?
So we're really seeing a big shift in where capital is being allocated around the world. Rates are coming down in Europe, but that's because the economy is not in great shape. The EU is no bigger now than it was in 2018. So money is not going into Europe right now, nor is it going into the UK. Money is going into the U.S. I think there's still a cautious approach to China, and money absolutely is going into Japan and Southeast Asia. And I think that rotation of capital reflects where long institutional investors, long-term investors, see the growth of the economy over the next decade.
Might that rotation of capital be impacted by the U.S. elections and the results? Does it matter who comes into the White House to help you shape your investment decisions on these things?
I'm certain that it will, but I would say that I think that the thing to watch the most closely in the U.S. elections is whether or not we end up with a split Congress. So regardless of who's elected president, if they are able to bring a unified Senate and House together, then you will see, I think, some real change, and you'll see an acceleration of policies. If we end up where we've been for the last 12 years, which is, the Congress is split, the chances of really getting through major policy becomes much more difficult. I mean, really, with the exception of the infrastructure bill, Biden has had a hard time, and Trump did before him. So I think that one shouldn't underestimate gridlock as an outcome in all of this, and that's not necessarily a bad thing.
So for financial markets, David, it doesn't matter who comes into office, whether it's Trump or whether it's Harris. So
far, as you've seen, the markets have not really responded particularly to their different economic policies, to different tax policies. So if you were to just say, what is the market telling us? The market so far has not reacted one way or the other.
What are you telling your clients about how to stay resilient as we expect greater volatility from the U.S. election?
Yeah, it's back to the real points around liquidity. I think that is really important. Because you don't want to get caught in a squeeze, and because many of our clients have been, heavily allocated to private markets, which they've done kind of very well. But then when you do have a big move and you want to take advantage of it, you've got to make sure that you're able to have liquidity to bear.
Right. Is there an underestimated risk in the market right now?
I think that the biggest belief that is there in the market now, which I think remains to be seen if it's true, is that the market clearly believes that there is a Fed put, and that the Fed will step in. And I don't mean just the Fed, but the EU and others, that they will step in, and when things get bad, they will make it better. The best case of that was when we had several small lenders go bankrupt in the U.S., and almost overnight, the Fed stepped in and guaranteed the entire balance sheets of middle market banks. And so I think there is a belief now that this put is real. Now, that's very dangerous, right? Because that's certainly there's a lot of moral hazard that goes with that. The Fed will not like that at all. And we've now have a whole series of investment professionals who've never seen anything other than that. And it does lead to the behavior you witness very clearly of kind of buying the dip. But I would say if you were to ask me one thing that is prevalent but dangerous, it would be, is that really true?
David,
I'll leave that.
Before we let you go, just one final question. Which asset class do you think will do the best by the end of the year?
That's almost never the way our clients care about things. They want to know.
24 months.
They want to know what is the whole portfolio of asset classes, which will allow me to meet my pension funds liabilities going forward. And the answer to that is that we have a much more broad diversification of public and private markets, which will include more bonds, more ABF, and more direct lending than we did over the last decade. And that will be absolutely good for retirees.
David, such a pleasure to speak with you. Thank you so
pleasure.
much
Thank you for having
dedicated your time with us today. David Hunt, President and CEO of PGIM. Now to some of the other top stories we are following today. New York City Mayor Eric Adams has responded to reports that he'll be indicted following a federal corruption investigation. Adams says he's innocent and intends to dispute the allegations. A source says the indictment is sealed and it's not yet clear what charges Adams may face. The FBI's investigation into his office became public last November. Some Democrats have urged him to resign as he seeks re-election.
Many may say I should resign because I cannot manage the city while fighting the case. I can also understand how everyday New Yorkers will be concerned that I cannot do my job while I face accusation. But I have been facing these lies for months since I began to speak out for all of you and their investigation started. Yet the city has continued to improve. Make no mistake, you elected me to lead this city, and lead it I will.
And Hong Kong property developer New World has suspended trading after Bloomberg broke news it's considering replacing Adrian Cheng as CEO. It follows write-downs that led to the company's first annual loss in 2 decades. New World is owned by Cheng's billionaire family. He became CEO in 2020. We're told Cheng could be replaced by the current chief operating officer, Ma Siu Chong. Well, still come on the show, Hamilton Lane's head of Southeast Asia will be joining us here at Super Return Asia in Singapore. We'll discuss how Asia stands out in the private market environment. Keep it here with us. This is Bloomberg. Welcome back to Bloomberg Markets Asia. China's markets are just heading to lunch. As we've reported, Beijing said to be considering injecting some $140 billion of capital into its biggest state banks. Sources say the funding will mainly come from the issuance of new special sovereign bonds. Beijing also earlier announced a one-off cash handouts for the poor ahead of the holiday week. Consumption stocks surging on the back of that news. Well, for more on the markets, let's bring in Bloomberg M Live strategist Mary Nicola. Mary, it does seem like China ramping up those measures.
Yeah, it's great news for the markets overall, especially if we're continuing to see some stimulus, but it's also going to raise the expectation that there's going to be more to come. So obviously the key thing here, and a lot of investors are looking for, is what are they going to do on the fiscal policy side? But of course, you don't want just any regular fiscal stimulus. You want something more targeted that helps boost consumption and domestic demand. And a lot of these stimulus measures so far, they do help, but I think the market is still going to be looking for more.
But what's good enough, Mary, when it comes to boosting consumption? What does China really need to do?
Yeah, it's a really good question, and it's something we've been discussing in terms of what can they do, what will they do. A big part of it is going to be helping support the property sector, building up and fixing some of the issues with the oversupply and bringing that market back up. Because remember, this is where a lot of Chinese consumers have their wealth. And if the wealth is, if consumers are going to start spending, this is where it needs to get some support. So it's really about the housing market and propping that back up. And it's also maybe about even stimulating demand in terms of, we've seen some sort of cash handouts, maybe some more in that direction could be a good, another big step too.
And Mary, what are you hearing in terms of which asset classes are likely to do well in China on the back of the moves we're seeing from the government?
Yeah, overall, I think equities should be holding up pretty well, but it's also about the trickle-down effect, not only in China, but to broader emerging markets. You've got a very favorable environment for emerging markets right now, with a combination of Fed rate cuts, China stimulus. It's hard not to get excited about emerging markets. It's hard not to get excited about EM currencies as well as a result of all this stimulus that we're seeing. So I think it's more than just China. So equities should continue to do well. We have this the stabilization fund, which essentially puts a floor and gives some sort of positive mood and continues that positive mood in equities. But again, it will also be about like the broader impact from these measures on the rest of the world.
Mary, in my conversation with David Han just slightly earlier, he talked about how he's refusing to look at emerging markets as a whole. You have to identify which market you're looking at in particular. Within Asia, which emerging markets in particular stand to, I guess, gain the most from China's moves?
Yeah, I couldn't agree with him more. You can't look at it as one big unit. They are so different, and clumping them together is a problem. And so I think you still have the likes of Korea, Taiwan. They're still going to benefit, obviously, from the tech improvement. We saw that today on the back of the tech surge in the U.S., and those still have strong fundamentals. And a lot of the big exporters, so Taiwan, Korea, and as well as Singapore, they should benefit. Malaysia as well, Thai baht. A lot of these countries do have really strong links to China. What I think might you see the setback is in Indian stocks. So you're going to see, as long as the rally continues, there's a lot of investors have been underweight on China. They're going to be looking to cover their shorts, and for there, they're going to likely look to India to do that, especially given its outperformance, especially given how expensive valuations have been. And then, of course, there's more scrutiny coming under on India, where there's less buys coming through. There's concerns about earnings, the earnings outlooks. So there's a little bit more than just overall China that's weighing on India. It actually looks at valuations and whether the valuations are being justified.
That's right, and not forgetting that regulators themselves are pretty worried about the euphoria in the market. Bloomberg MLive strategist Mary Nicola, thank you so much for that. Now to a Bloomberg scoop on OpenAI. Bloomberg has learned the company behind ChatGPT is weighing giving CEO Sam Altman a 7% equity stake. Let's bring in our tech reporter, Annabelle Drulers in Hong Kong. Belle, this is a major shift.
It absolutely has. I mean, you think about what we've heard from Sam Altman in the past, even as recently as a few months ago, saying that he didn't want to have any sort of equity position in the company. He only really would want it, and this was sort of in jest, just to stop people asking about it. But Sam Altman has made it clear in the past that having an equity stake wasn't something he was interested in, given the structure of OpenAI as a business that was very much focused on providing benefits to society at large. That appears to have shifted, and now we're hearing that the company could actually be weighing giving him a 7% equity stake, as we also hear from sources that it's looking to shift the nature of the business to become a for-profit organization. And that's significant because going back to when OpenAI was established in 2015, it was a not-for-profit structure, and again, it was intended to be helping society. Fast forward a few years to 2019, the company was taking on a lot of funding, and it created a subsidy that had a for-profit basis, which sat, of course, underneath the non-for-profit umbrella. That appears to have created some tensions at the company. We heard at the end of last year when Sam Altman was briefly ousted as CEO that was one of the issues was leading to the tension. It does seem that perhaps they could now be mulling just finally shifting the structure of the company completely.
And, Belle, of course, worth noting that this is happening at a time when we're seeing an exodus of senior management.
Yes, absolutely. We've seen a lot of different key personnel leaving the company in recent months, but the latest is a very important one as well. The CTO, Mira Murati, announced a resignation on X overnight, and also to the company, of course, but it really took a lot of people by surprise, and sources are telling us that internally on their Slack channels, a lot of people were expressing their caught unawares, essentially, by it. Mira Murati is someone who's been a very key personal figure at the company since she joined back in 2018. She was chief in the rollout of ChatGPT, in the rollout of the voice assistant feature we had this week, in software that generates images. So she's really been a very key player. We did actually hear from Sam Altman himself as well on X, saying that he was, of course, saddened by the loss or the choice of Mira Murati. Her resignation date isn't set just yet, but still he said that turnover is a normal feature of any company, and that they've got a strong bench of talent that they're developing to, again, take on these key positions. But at this stage, we actually only have a handful of the early people that were at OpenAI still at the business.
And, Belle, on a side note, we're watching Asian-linked chip stocks today after Micron earnings. What's happening there?
Yeah, that's right. We had Micron reporting in late trade, very robust numbers. We saw Micron actually soaring itself, the company's stock. It has had a play-on effect or an effect in Asian trading today because we're seeing supplies to that company also rising in tandem. The reason that we saw such strong numbers from Micron, it points to demand around its AI products in particular. It's a supplier of so-called high bandwidth memory or HBM chips, which are key to powering AI tools. It's been a very strong seller for the company, but broadly the outlook for the fiscal first quarter, they see it at $8.7 billion. The average analyst estimate had been for 8.3, and also 93% revenue jump in the latest reporting period. So again, it just tells that story. We had seen concern around whether the demand for AI tools was going to continue. This is a signal, yes, perhaps has.
That's right. Annabelle Drewlitz in Hong Kong, we thank you so much for that. Now, Meta has debuted its first pair of augmented reality glasses called Orion. The prototype has lenses that can display text messages or video onto the user's field of vision. An accompanying wristband also allows wearers to click or scroll on the display using just their hands. Meta's Chief Technology Officer, Andrew Bosworth, says he expects the glasses will become a consumer product within the next decade.
I think we're more than 1 year away, less than 10 years away, but we have a very clear line of sight to a consumer product. The price isn't clear to us yet. One of the big things going from a prototype like this is understanding what can we learn that allows us to simplify, or what do we need to keep in future designs, and that's going to control where the price lands. But we really want to get this into a price point, a form factor that not just consumers use it, but developers want to build for it.
All right, plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back, and we're coming to you live from Super Return Asia here in the Lion City. In a rapidly evolving investment landscape, limited partners such as pension funds, institutional accounts, and wealthy individuals face growing challenges when building resilient portfolios. Let's discuss this and more with Karine Koh, head of Southeast Asia at Hamilton Lane, a private markets investor with over $900 billion in assets under management. Good to have you with us.
Thank you. Great to be here.
It is really hard to build a portfolio because the environment is so uncertain. How are you looking at it?
Yeah, the way that we think about building portfolios is that investors need to think about the long term. So there could be a lot of noise in the short term, but for them to think about what are the foundations of their portfolio, they need to think about what are the returns that they want to make, what are the risks they're prepared to accept, what are the liquidity that they are prepared to withstand. And with the answers to these three questions, they would have enough to form parameters of the portfolio and then layer on what is the market environment out there, what are the excess vehicles out there, potentially what are the ESG considerations or any thematics that they may have out there. So I think it's really a layered approach, and investors need to do that on a more systematic way.
So when we talk about long term, let's put a time frame to it. If I take a 10-year perspective, taking into account the realities today, how does my portfolio look like?
Yeah, so again, I think in terms of the long term, it depends. So for instance, if you are an investor that has high returns needs, you are going to end up with more private equity rather than credit. But if you are an investor who are looking for distributions, shorter tenure, a little bit more balance in terms of the volatility, then you may end up with private equity and credit, potentially around 20 to 30% in credit versus private equity. And if you're a little bit higher octane in terms of risk appetite, instead of having maybe around 75 to 65% in buyouts, and versus 25 to 35% in VC and growth, you might actually tilt that up to have a higher allocation to VC and growth. So it really depends on what the investor is looking to achieve at the end of the day.
And of course, you talked about risk appetite. How much risk appetite is there? We're looking at an environment where the Fed is cutting rates, but of course, lots of noises out there, given the elections, given the uncertainty of policies. What's the risk appetite right now?
Well, I think it's a fine balance. Obviously, with any rate cuts, people are on edge because the fear of recession is always in the backdrop. But again, in terms of taking risk within risk assets, I think it's a great opportunity to move out of deposits because now it's actually fairly less attractive. So we are actually seeing a tick up in terms of risk appetite, and this has gone, I would say, over the past 2 to 3 years into areas that are moderate in risk within private markets, such as in private credit. And now we're actually seeing some rotation with the rate cuts into private equity. And with that, within that, we actually think that the fastest to recover in terms of deal flow, in terms of activity, will be actually mid-market, because we are actually seeing some mid-market M&A activity come back, and mid-market is always a space where there's actually more exit optionality for companies versus the larger cap.
There's a lot of optimism when it comes to private credit. Which markets are looking interesting?
Well, I think in the last couple of years, obviously the performing side or the origination side has been super interesting, because you could be taking top of the capital structure, senior secured direct lending, and you're getting low to mid-teens returns. Now, I think investors are starting to look at the medium to the longer term, but even if we look with it in that lens compared to 5 years ago where interest rates were super low, if you think that base rates are going to come in different speeds out there into what is a neutral base rate of 3.5 to 4%. And on top of that, I do think that middle market direct lending still can get investors a pretty healthy return of 5 to 6%. That's actually still 8 to 10% unlevered returns, which is still pretty decent.
So that would be the super return. I mean, we're here at the conference called Super Return Asia. Where will you see this super return in Asia?
Yeah, I think for us, we pick our spots into that rotation into private equity. And here we believe that, again, back to the fact that when you have rates coming down, this is when some of the M&A activity will pick up, because leverage is now cheaper. Companies have a little bit more breathing space in terms of their credit. They're not having to fork out as much cash. And that is when companies can start to expand and use their cash to grow their businesses. And this is where we see that potentially more M&A activities will happen. Investors will start to see more DPI. And then with that, higher returns, I think, especially starting from the middle market space, which we see as $1 to $3 billion enterprise value companies.
Corinne, pretty interesting. In my conversation with David Hahn just slightly earlier, he talked about how, you know what, not too long from now, you're unlikely to be differentiating between private and private markets. Your thoughts on that?
Yeah, I think it's interesting because clearly private markets has been expanding. So we're talking about over the past 20 years, private equity was around $1 trillion. Today it's exceeding $12 trillion. And much of that has been the migration from public markets into private markets. So if you think
like pension
about
funds and so on and so forth.
But even delisting, take privates, right? There used to be Wilshire 5,000, and there are no longer enough companies to make 5,000. So there has been that privatization, private for longer phenomenon. And as we see that the private markets are actually maturing, I think we will see more capital and more companies actually opting to grow their business within the private markets realm for longer and to be larger before they actually go to IPO. So I think, yes, I think the lines are blurring, but I think they're blurring a lot more into that shift of public into private.
Right. And when it comes to Asia versus Europe versus the US, how attractive is Asia looking?
Well, I think that Asia speaks for 57% of world GDP growth, but today only represents around 10% of private capital fundraising by net asset value. So I think there's actually tremendous room for growth because private markets is about growth. It is about the growthier aspects of equity. So I do think that there has been a bit of a mixed, it's a diverse region as well, but because some of the challenges that has been coming out of China, and that's actually around 50% of private equity markets in Asia, so it has looked a little bit more muted. But as you see some of the policies come in place, I think there are other markets within Asia that look interesting. I think
Japan.
that growth will come back.
Like Japan?
Like Japan, for sure. We like Japan. We like Japan. So we think that there's been some solid growth in Japan, for sure. And you actually can see that Japan is slowly emerging out of those lost decades of deflation, and that is still relatively cheap.
Finally, a reversal in fortunes for Japan. Perhaps. Corinne, thank you so much for that. Corinne Lowe of Hamilton Lane. Well, the U.S. and its allies offer a truce plan to avert a wider war in the Middle East after days of Israeli airstrikes in southern Lebanon. Details of their proposal next. Keep it here with us. This is Bloomberg. The US, EU and major Middle Eastern powers, including Saudi Arabia and Qatar, have proposed a 3-week ceasefire between Israel and Hezbollah in Lebanon. For more, let's bring in our Asia senior editor, Bill Ferris. Bill, give us the latest on that.
Right, just within really about the last hour, the U.S., European allies, and key allies in the Middle East and Asia put out this proposal for an immediate 3-week truce between Israel and Lebanon. They said that the risk of escalation into a much broader conflict is pushing the urgency of this proposal. They've called on Lebanon and Israel to immediately endorse that proposal. We're waiting to see whether that happens. Israeli Prime Minister Benjamin Netanyahu is actually en route to New York for this meeting of the UN General Assembly, heads of state from around the world there. The conflict in the Middle East has really been the dominant issue so far this week among the world leaders gathered in New York. This is seen as the latest and perhaps a last-minute bid to de-escalate the situation after we've seen Israel ramping up its attacks on Hezbollah and the first Hezbollah missile aimed at Tel Aviv just a few hours ago.
That's right. What more do we know about that? Israel widening its airstrikes after Hezbollah fired at Tel Aviv.
Yeah, Hezbollah saying that it was targeting Mossad headquarters in Tel Aviv, and Israel continuing to go after what it says are Hezbollah targets. That includes missile launchers, weapons depots, places like that. Israel saying that its goal is to allow 70,000 people who have had to evacuate northern part of the country to be allowed to return. But the broader conflict has stoked fears that if there could be some kind of a ground invasion potentially of Lebanon that would draw Iran more directly into the conflict. So the U.S., its allies, and powers in the Middle East trying to stave off that effort, and also hoping if they can get a 3-week ceasefire between Israel and Lebanon, that may provide some dividends to work towards peace between Israel and Hamas as well.
Right.
But a lot hanging now on whether Lebanon and Israel accept that proposal. We should know more in the coming hours.
Bill Ferris, Asia Senior Editor, thank you for that. Now for the top political stories we're also tracking right now. Pakistan has secured final approval to start a $7 billion loan program from the IMF. This will unlock crucial financing to sustain the nation's recovery. The state bank governor says the bailout allows for an immediate disbursement of about $1.1 billion. Pakistan has been relying on IMF aid to keep up with its debt obligations. And Russia is set to revise its nuclear doctrine to include a response to what it calls aggression by non-nuclear states. The decision comes after President Vladimir Putin warned the U.S. and European countries against allowing Ukraine to strike deep inside Russia using Western long-range high-precision weapons. The U.S. hasn't announced any decision to permit attacks despite pleas from Ukrainian President Vladimir Zelensky. And that is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.